Welcome, everyone, to this episode of the Expansive CEO Podcast. I am your host, Hannah Chapman, and it is Thursday, May 1st at 4:10 p.m., just to put a timestamp on it, because this is the next installment of Investment Friday with Brad Haines, Chief Investment Officer of Juncture Wealth Strategies. How you doing, Brad?
Doing well. How are you?
I'm good. I told you before we started recording, my house got hit with the stomach virus that's going around. Literally everyone, I haven't gotten it 100% yet. I'm still like, my body's like, nope, we're good. We're not doing this. But yeah, all three of my kids, my husband, everyone, thankfully, we're almost on the other side of it. So that's my week so far. How about you?
Hey, it's been going pretty well. The markets have been behaving themselves, I guess that we should say. The markets have been running up on some pretty decent tech earnings from some of the larger cap, Microsoft's, Meta, which Meta is the owner of Instagram, WhatsApp, Facebook. Those have come out really well. So that's been very, very helpful for those stocks. Other stocks have really, really struggled. Some people have come out and, for example, United Parcel Service came out and said, "Hey, we're going to be laying off 20,000 people."
That's UPS, if you didn't
That's
catch that.
UPS for everybody else. But they still employ 400,000 people. So let's not get too excited. But 20,000 people is a lot. So in their global employee workforce. And so it's been very, very idiosyncratic about who's announcing what. One trend, which has been interesting, the last time we saw this was in the pandemic area, pandemic time frame, was a lot of companies are suspending forward guidance. What that means is when companies report earnings, part of that conference call or part of their guidance is, hey, how do we think our business is going to do over the next little while for the remainder of the year? And oftentimes they call that forward guidance. So the management of the company is guiding analysts in saying, hey, we're doing really well, or we're not doing so great. We think this might be, we might go through a retrenchment, or hey, we think we're going to continue to expand in a good clip. Um, so that guidance is very, very important for analysts to establish their assumptions based on what the revenues and earnings are for the remainder of the year, which then translates into how much is this company worth? How much should it be worth?
Right.
And because of the uncertainty surrounding the tariffs and the trade related issues, a lot of companies cannot give that guidance with any measure of confidence. So they've just stopped giving it. Again, like I said, this happened in the pandemic era where, we just didn't know what we didn't know about COVID-19. It could have been, very, very highly lethal like Ebola virus, or it could have been like the flu. Well, fortunately, over time, it became like the flu. Whereas, not to say that it's inconsequential. It's just not as dangerous as let's say Ebola, which has a very high death rate.
Right.
Uh, so again, that's a very unusual step for companies to take, and it tells me that a lot of the earnings projections for the S&P 500 for the remainder of the year are very, very suspect. They're not being updated very quickly, which means a lot of that data can be very stale. If it's stale, then you can't necessarily rely on it for how the value of those companies, at least at this point. Um, so it'll be interesting to see how the market reacts to all of those this week. Like I said, they've been behaving really, really well. The equity market has rallied pretty significantly based on tech earnings, um, and have begun to shift their focus from tariffs to other things like earnings.
Well, yesterday, so on Wednesday of this week for me, 2 days ago when you're listening to this, uh, we did get some pretty big news that rocked the markets in the morning, and they did come up quite a bit from, the overnight trading. But that GDP, which is gross domestic product, the measure of how much our economy is working, basically, came in negative. which it has not done since 2022. Right. So it's been a while since we had a negative quarter. It came in at negative 0.3%, which is just barely negative, but still, I think the prior quarter came in at 2.4. Is that correct?
That
2.4%
it,
positive.
that's correct.
So Q4 of 2024 was a good solid GDP number, right? That's what we like to see. So the negative zero point 0.3 rocked the markets pretty hard when it came out. What else should we be considering and thinking about with that?
Well, it's interesting because one, it's negative. Okay. Underlying, it wasn't as bad as people had anticipated because when they saw the headline number of, oh my gosh, we're in contractionary territory, which means, if we have inflation with no growth, it means we're in stagflation. That
Right.
word of stagflation means no economic growth, higher than you want inflation. That's a stagflation. But it also indicates that we might be sliding into a recession, which again, the rule of thumb is two consecutive of quarters in negative GDP territory. So it contracts for two consecutive quarters. Now, that is a rule of thumb. That is actually not the criteria, but it kind of follows along with all the criteria. As if it's negative, then the other criteria is going to work out. Um, so part of what we're looking for, because consumer spending was actually pretty decent in that era or in those months in that first quarter. And we had some inventory building ahead of the tariffs. So part of what we're looking for and what we're going to be paying attention to is how much of the sales consumer spending was and business spending was pulling forward demand from the second, third, fourth quarter of this year into the first quarter to try to avoid paying the higher cost of the tariffs. Um, so consumer spending was pretty solid, but there is this underlying thought of, well, that could also be part of the spending for the rest of the year. We just don't know until we see more high frequency economic transaction data in the next few months.
So which pieces, because I have some thoughts on that, but which pieces came in negative then? If consumer spending was decent, what were the parts that pulled it negative? If we can parse it out at all.
That's a great question. Hold on, let me.
While you're looking for that, because my thought with that was that okay, if we're still negative, but we had people spending more and companies buying more inventory, so we actually had more economic output than normal from consumers and businesses buying, but we still came in negative. That to me seems like those are compounding negatives on each other, right? So, because yeah, for my
Yeah.
family, if we're gonna buy things ahead of time thinking, oh, we're not going to be able to get this thing, then you're right. That's more of a like I'm not going to be spending this money in Q2.
So what was your question? What came in negative as
Yeah,
opposed?
what pulled it
Okay.
negative? Why did we end negative?
Well, part of the negative was inflation. Obviously, inflation had ticked up just a little bit month over month. And so that did it too. And then real consumer spending, adjusting for inflation, was 1.8%. That's down from a previous 4%. So it's still positive, but not super positive, right?
Okay.
Um, and you had personal income, which came in uh, just a tick higher at 0.5% as opposed to 0.4% was the expectation. And then personal spending ticked over 0.2% higher, so about 40% higher than its expectation. And that's where that consumer spending, and a lot of it, some of it came in pending home sales, where month over month it grew by 6.1%, and the
Mm-hmm.
expectation was 1%. So
Yeah.
that again was a very positive number, um, relative to now. Uh, Government data, the trade economy, which is part of that calculation, has probably shrunk
Hmm.
uh, quite a bit as we import more and export less. So the trade deficit has actually widened this year, which is actually counts against GDP growth.
Okay.
And then also government employment has contracted.
Hmm.
So part of all those things are what caused it to go down. But again, negative 0.3% is not really that negative. And it'll become worrisome if, for example, in the next couple months, we can see a dramatic slowdown in economic transactions, meaning, you know, people using their credit cards, people
Hmm.
using their debit cards. What's the total volume across the country? Is it lower? Is it higher? And we can start to assess whether this consumer spending was pulling things into the first quarter versus the second and third quarter.
So w- one of the things that goes hand in hand with that, that some people may have been hearing headlines about, is that the ports, so especially the ports on the west coast of the U.S., Los Angeles, Portland, Seattle, all the way top to bottom, have been seeing far, far less traffic. So a lot fewer container ships coming into port uh, because of the trade war that's happening right now. And so, what we're looking at and watching for really is what does this do to the supply chain? If we don't have goods coming into the ports, then we don't have goods on the shelves in some of our stores. And what does that start to do? And so, if you've been hearing that kind of rhetoric coming out as well, what are we looking at there here at Juncture and from the financial market standpoint?
Yeah, so that's one of the pieces that is very, very difficult to assess its impact on the overall economy going forward. I know that the head of the Port of LA this week announced that as early as next week, they'll start to see a 35% decline in shipments from China. So um, bear in mind that across the western coast of the United States, the ports, on average, about half of the traffic going through these ports is from China. So a 35% decrease in the port of Los Angeles, which is the busiest port on the western half of the United States, is a big, big decline.
Hmm.
So, what does that do? Well, one, as you inferred, I mean, certain goods are not going to be available within a couple months. It takes any trade snafu, um any trade problem, whether it was a ship running aground in the Red Sea or, the Red Sea or, um, or, the COVID-19 shutting down the economy and restarting it or massive tariffs being placed on one or a couple of our large trading partners, that it takes a while for it to get through to the U.S. consumer to see the effect on the goods that they want. Um, it takes a while, it takes a few months.
Hmm.
And, you know, uh, most economists estimate that in May, you'll start to see that the western half of the United States consumers will start to see those problems. Okay. And then as long as this goes on, longer and longer it goes on, it'll go towards the East Coast, and people, you know, I don't want to sound dire because I mean, if you're not able to buy the fuchsia towels that you wanted from Kohl's, it may not be that big of a deal. You can just buy another color, but um, so I don't want to make this seem like it's a disaster, but it is going to constrain the available goods on the shelves. Retailers is going to probably be the most recognizable, the most visual or visible effect of those tariffs. from people's perspective when all of a sudden you're going to start to see some shelves on our big retailers struggling. In fact, the CEOs of Walmart, Target, and Kroger sat down with President Trump and described how this is really starting to foul up their supply chain. So just know that this is a temporary issue, and that we'll all get through this, but there might be some shortage of goods coming up the next few months.
Yeah, that's the kind of getting to the topic that we wanted to talk about today, which are the different types of bear markets that tend to happen here in the United States. Because even if we were to reverse course now and say, oh, the tariffs were all just that we were just trying something out and we're gonna not do any of that anymore and just lift all the tariffs, we already have a supply chain issue, right? Like ships take time. If they're not coming, if they've been docked, which they are, it's going to take another 30 days for a ship that's been docked in China to get over to the port of LA, right? So even like again, if we reversed course right this moment, we still have all of May where, it's going to take time for stuff to get here. We're not going to see things changing really until June or July.
Yeah.
And so, with that in mind, we've been seeing, some of the recession indicators go,
So
tick up, right? So, like sometimes they're green and like no indication of a recession whatsoever, and then they'll turn yellow for a little while if there's, a couple of things going on. So, the fact that we've been starting to hear the word recession more in mainstream media, um, and just everywhere, really, right? Like people are talking about it, like we might be in for a recession. Um, I wanted to really talk about what does that look like? What are the different kinds of recessions and bear markets that we've seen before? And what does this one potentially echo if we have to have something to kind of ground ourselves into? Okay, this is what I can maybe expect, maybe plan for, and then know that we'll get through it.
yeah, okay. That sounds great. I'm gonna share my screen because I'm gonna share a couple of charts. So if you're listening to this, we'll try to walk you through it as best we can so that you're able to kind of go on this journey with us a little bit as well.
And if you have a chance to go over to YouTube, you can go to Expansive CEO on YouTube and you will find the video there as well. So you can actually see what we're seeing.
All right.
Brad's just getting his screen ready. There we go.
I apologize. Sometimes Zoom is not quite as fast as we would like. All right, so the chart I'm sharing you is from Goldman Sachs. They've broken down bear markets into different types. But let's start about the average. So this is bear market recoveries and bear market declines since the 1800s. So a while. Okay. There's a few in here.
Yeah, 150
Um,
years of data.
yeah. So on average, you can see that the average bear market from peak to trough, we're down somewhere in 35 to 38%, somewhere around there. And on average, it's right there. That's the big blue dot right in the middle. That's kind of the median. Okay. Um, what the median does is it allows us to get rid of the really extreme examples,
Hmm.
right? Like, so it's something to help give a better indication of what would actually happen, whereas the average gets influenced by the really, really negative bear markets like the Great Depression.
Hmm.
Um, the other one is structural. Something is happening in the economy that is structurally different now than it was. A great example is 2007 to 2009, where one part of the economy, the real estate and mortgage lending sector, got really, really crazy. And that structure had to change. We went through what's called a balance sheet recession, where households and businesses' balance sheets, their asset side, those assets were worth less than what they owed on them. right? If
Hmm.
everybody goes back to that time frame, they bought a house at $500,000. They have $475,000 in mortgage, and it went down 10%. Well, now you're underwater, right? So you
Right.
have a lot of short sales, foreclosures, and the like. So we're not here. This is structural is pretty rare. It does happen, but they're also very severe on the drawdowns, where the peak to trough. Around 50 some odd percent is what you can expect a drawdown. And that's pretty much what we did in 2000, from 2008 to early 2009, before March 9th, when the equity markets bottomed and started to really climb towards the second half of 2009. Um, they're very severe. Again, we don't think we're in this one.
Hmm.
Cyclical. Cyclical is your normal bear market. It's your normal, it's a, hey, by the way, things are going too well. Inflation starts to creep up. The Federal Reserve steps in, increases interest rates to a certain extent, slows down the economy. Oops, goes a little too far. We fall into a recession, and we have a 25%, 25 to 28% decline from peak to trough in the equity markets. Okay. Kind of normal course of business. The Federal Reserve steps in, they start to lower interest rates, and the equity markets back to the races.
So that
Nope.
one, before you go into the last one, with the cyclical bear markets, that's where, if you've been hearing the term, the Fed has been trying to engineer a soft landing for the last couple of years, right? That's the type of recession we were maybe flirting with over the last couple of years, right? Where
Yes.
where the Fed was raising interest rates, raising interest rates, raising interest rates until they got the signal that it would be okay to pause. Right. And so that's where, those types of recessions tend to recover quickly because all it takes is for the Fed to lower interest rates again. Right. And then the equity markets pop right back up.
Yep. Yep. Exactly. The third is event driven. And the best example is, uh, or the last two, is COVID-19.
Hmm.
COVID-19 was a non-economic factor, or a non-economic issue that created a massive issue in the economy, right? Um, so they're probably the slightest in terms of drawdowns, because the government steps in very, very quickly, because they can evolve into a structural type uh, drawdown, a bear market. So the difference between that event and structural is, the government stepped in to backstop it to the extent that we were able to solve that issue. Um, Now, arguably, they stepped in a little too much, which is why we ended up with pretty good inflation in 21, 22. Right now, because this is a tariff-driven policy, this is a event-driven bear market. Okay. And I think we're in a bear market just based on the trading. And I'm gonna describe a little bit of why that is, because I'm sure a lot of clients or investors are listening to this going, hey, we just went up 10%.
Hmm.
You're really down 8 to 9% now in the S&P from peak to trough. Well, there's a lot of times that bear markets have what we call bear market rallies. And I'm going to try to make this bigger. This is 2020, 2000 to 2002, um, where from peak to trough is negative 49%. So
So
half.
this is an interesting example too, right? Because this is the
Mhm.
dot-com bubble burst.
Correct. So this would be an example of a structural bear market. Okay. But I want to give it an example because it really did. People forget how much we rallied within this bear market. So peak to trough, it went down 49%. But in the meantime, we had one, two, three, four, five, six, seven, eight rallies of over 5%.
Hmm.
Okay. In short term. We had one, two, three, four. We had four rallies over 10%. We had two rallies, well, I'm going to count three, of around 20%.
Yeah.
Three rallies of over 20% within a longer downturn, which eventually bottomed out at 49%. Now, the reason I'm saying this is because this is not, uh, it, today is acting very much like a bear market. Okay. And I'll give you a couple of reasons why. But here's another example: 2007, 2009. Again, this is another structural, but we had five times where before the bottom was 57% down, but we
Hmm.
rallied quite significantly five or six times during that downtime. Now, I'm sharing this with you because not that I want to scare anybody. This is not a scary thing. This is normal. This is a normal part of the bear markets that we have significant rallies. I've had people ask me, is this kind of the end of the bear market? I mean, the markets are going up. Not really, because here's what's happening. I think April was a really great month for this microcosm. So what you had is um, an S&P 500 ETF from Vanguard. Okay, it took in 50 to 60 billion dollars in funds.
Wow.
Okay, wow, that's right. Wow. The other large S&P 500 ETFs all lost money. Now, why is that? Why did we had massive outflows from one set of, but this one particular one had a lot of inflows. Well, Vanguard happens to be the most popular choice for retail investors. So the retail investor is stepping in right now
Hmm.
with this investment. The institutional investors, the hedge funds, the pension funds, the mutual funds, the money market, the professional managers, the money managers, all stepped away from U.S. equities last month. Okay, so that's really important distinction that when the retail investor buys in, that means we're not at the low. The way people know we're at the low is when everybody who wants to sell is done selling. No one
Hmm.
is buying. Okay, and so right now we have this cross currents where the professionals are kind of becoming way far more conservatively, and the retail investors are becoming much more aggressive from a valuation from a purchasing standpoint. Um, it's something where uh, right now the level of uncertainty is very high. So as a professional money manager, we are positioned more conservatively than normal.
Hmm.
Okay. We're not typically this conservative in our bench. Now we're still invested. So I don't want to make anybody think we're not invested because we still are. We just reduce the amount we're invested just a little bit.
Hmm.
Um, and the reason why is because there's a lot of uncertainty. And during uncertainty, you don't want to make a bunch of changes. What you want to do is you want to kind of risk down your portfolio a little bit and then wait for the eventual bottom where you then reinvest those funds back into equities. Um, we have a number of clients that have come to us that have excess cash, and we are putting that to work over a period of time as volatility gives us better entry points. All
Right.
right. Um, so with the potential of a recession, with the potential of earnings not necessarily doing fantastic for the remaining part of the year, with potential inflation coming from tariffs, even if it's sporadic, or not even sporadic, but even if it's a doable number, right? Let's say it adds a percent to the overall inflation rate, which right now the PCE is 2.3%. So 3.3 is non-event. It's a big deal. We can handle that, not a problem.
Yeah.
Um, but the bigger risk, and this is the one that we've talked a little bit about, you mentioned, is what's the supply chains going to happen? What's that impact on inflation? Because if we go back in and let's say it's not a COVID-like response, but it's a it's somewhere around there. I mean, do we get to 5% inflation because of the goods scarcity? I don't know. That's a possibility. A lot of the trade economists and the economists that I've talked to and I've read their reports um, have specifically excluded that event from any of their analyses because it's too it's unknowable. It's so complicated and you just don't know, you know, there's a lot of there's price elasticities you have to know for each of the products, and then it's just far too complicated. It's far too complicated to try to figure out and place into a neat number. So they exclude that from their analysis. So, does inflation get up to 3, 4, 5%? 3 or 4%, no big deal. Anything above 4%, and I think you're going to have a lot of U.S. consumers very, very unhappy.
That was like surprising for me to hear. And when you explain it that way, that it's like so complicated that you can't factor in all the unknowables, I get it. It makes sense. But I hadn't heard one single economist actually say that out loud yet, that, oh, we're actually not factoring in supply chain disruption. Like, oh, wait, hold on. Like, that to me is actually the bigger question mark and the bigger concern is the supply chain disruption where, I mean, the Peterson Institute, lots of places have come out saying tariffs will add, maybe a percent or less. Like, okay, like we can deal with that. Not that the US consumer wants more inflation necessarily, than we have to deal with. But because of the way, and we've talked about this before, because of the way it was rolled out, because of the way things were communicated, because we now have ships waiting and docked in China, not coming over to the United States, that's where this second factor of, okay, now it's not just tariffs, now it's supply chain. Um, so that for me is also where, are we through the woods? Are we out of the woods yet? I don't think so either. I think we have to wait for second quarter earnings. And I've said this directly to clients as well. I'm like, we need to wait until second quarter to see how things are panning out. We actually haven't felt as consumers, except for maybe very few occasions, we actually haven't felt the effects of the tariffs yet. So like
No,
when we go to the grocery store, we haven't felt it yet because the stores have supply. So they're still getting rid of the supply that they bought before the tariffs. So we actually haven't felt it yet. We're in the
no, it's not baked into any of the economic statistics yet.
right. So we can't say that what Q2 is going to look like and if that's going to be negative GDP just yet. So for me, that's the same. Like caution, not caution necessarily, but just be aware, have intentionality if you have excess cash to put into the market. Like you said, like we're going to take opportunities when things drop, but don't feel like that since the market has come back up about 10% that you've lost the opportunity for the year.
Yeah, no, I think we still go below where we did a couple weeks ago, which was we knocked on the door of 20%. So I still think we go back down to that level, maybe exceed that level a little bit before an eventual resumption. Now, we've talked a lot about problems over the next, let's say 12 months, right?
Hmm.
Those are problems, right? Tariffs, supply chain issues, all that stuff. Now I want to kind of step back and give clients why would I invest if that's the outlook, right?
Hmm.
That sounds horrible. It does. For the next 12 months, there's just a lot of uncertainty. But I want to highlight, I'm going to use a couple of tech companies, I think this week that came out with earnings are the reason why I think you should invest if you have a longer time horizon than 1 to 2 years. And here's why. Tariff costs will be adjusted to over the next year or two. Okay. It'll be baked into the price. It'll become much more normal to the consumer. You'll just get used to it and start to go on. It's not going to be great in the first year or two, but beyond that, I think it'll be fine. Um, but we're in the midst and just scratching the surface of a technological innovation trend that will be able to enormously benefit the US companies and consumer and really the globe. But artificial intelligence, um, robotics, nanotechnology, personalized medicine, all of those innovation trends that we're just literally scratching the surface. I mean, AI right now, the biggest interface that we as consumers have is with the chatbot on any website we go to for any company that we want to buy their product. Um, that's our biggest interface. Well, it's really far beyond that. I guess Chat GBT is another big interface, but it really is going to extend far beyond that. And it's going to, my guess over the next 5 years, the office place will be a very different place, a very efficient market compared to today. In fact, Bill Gates came out today, and I'm not going to say he's right, but I think his intention and his meaning is correct, is that workers are going to work 2 days a week in the United States because AI will be able to effectively assist humans with all of these duties that normally a bunch of humans have to do right now. Okay, so it will make it'll make the future company much more efficient. If you look at a trend of profit margin for all companies in the United States, we went from basically 2% in 1992 to 18% last year. So that's a big increase. And a lot of that has to do with the internet
Right.
innovation,
Mm-hmm.
right? The internet. If you think of all of the stuff, and I'll give you an example of when I started managing money, I had to literally, if I wanted to execute a transaction, I had to write a physical ticket. It's a paper ticket that I'm going to buy 100 shares of XYZ company at whatever price I wanted to do it in, write the account down,
And
write
your
the name
carbon
of the account.
copies, right?
It had 3 copies. There was a white, canary yellow, and pink. Okay. And I went to the pneumatic tube, I put it in there, and I shot it to the ticket operator. That person then entered the order in. It was electronically transported to the floor, and the transaction got done. So that is how I used to execute transactions. Now, anybody can go online and do it within a second or two. They can do a trade.
Well,
I
and
can
with
go
that, you
ahead.
can also do it with like now, the technology we have now, you can do a trade across the entire client base if you're having the
Yes. So
same trade, right? Like, so it's not like before you had to write out a ticket and send it, and then write out another ticket and then send it. If you had three clients wanting the same thing, you literally had to physically do it for
yeah.
each account.
In fact, we just did this in our accounts across our entire book of business, 1,000 accounts or so. We did it within 5 minutes. I mean, it was simple,
That is
fast,
crazy.
exit. I mean, it doesn't take any time. And the reason why, the only difference, in fact, the person who executed that trade at our firm used to be a ticket operator back when she started. So between she and I, it's like we can do the work of 20 people that normally would have, 20, 30, 40 years ago, it would have taken 10 people to do those jobs. And we can now do it with the assistant of technology. So what I'm telling people is, yes, over the next year or two, we might have some bumps in the road. We're going to have some equity market volatility. Is there better times to step into some of these stocks? Absolutely. If you're a client who um, has accumulated some assets and now needs to start living on them, great time to start picking up some high dividend stocks. Really great time to pick off those. You can get some really good dividend yields, really solid balance sheet companies, good revenues. Great time to start picking those up. Really a great time. So changing that type of portfolio it's a good time to do that. But if you can extend your view beyond the next year or two, we're really just at the beginning of this innovation curve, which is really going to benefit all US companies from the very largest tech companies to the very smallest um, individual sole proprietor sitting in his or her garage or bedroom with a computer, and they're executing on their vision. So I'm very, very, very excited and optimistic uh, about the equity markets 3, 4, 5 years out. The next year or two, yeah, I'm excited about them, but I recognize there's going to be some bumps in the road, and as a client, you don't want to react to those bumps to the detriment of your financial plan.
Yeah. And as we saw in the chart, those those data sets go back to the 1800s, right? So we have, again, as we keep saying, these things happen. They happen with regularity. They're not always the same. A lot of times they rhyme pretty closely though. And so that's, we could even go, that could even be another episode sometime where we talk about the Smoot-Hawley Act,
Yeah.
and the recession slash Great Depression that happened after that. But again, we have the benefit of knowing more so that the government knows how to step in a little better this time. So
Yeah, just to put everybody in mind at ease, the Great Depression was caused by 4 or 5 massive missteps on the government's part and it created the Great Depression.
yeah,
So my guess is we probably will never see something like that again, because the government is more aware. We have more safety stops.
the banking systems are more regulated than they used to be as well. Like,
Oh, far more
like,
regulated, far, far more regulated and healthier, so
yes,
much healthier. I mean, and we can talk about the Great Depression at some point, but the Great Depression was like the heady times before the Great Recession that we went through in '06 to '09. It makes that time look like a joke. It was so much more speculative.
interesting.
It,
Maybe we'll
it
have to do a history lesson.
Yeah, we'll have to, because it's very interesting. It's very, very interesting. So,
Beautiful.
um,
Well, thank you so much, Brad, for being here. I always appreciate your wisdom and the time spent with you. And as always, if you have any questions, you can absolutely send us a note, give us a call, send me a DM on any of the platforms if you follow me anywhere, or just send us straight up email. Everything is in the show notes for how to get a hold of us. And if you really appreciate the way that we talk about the economy, we're here to help. So literally give us a call if that's not something that you're getting now and you would like to have more solid education and execution on in your life. Thank you, Brad, for being here. I appreciate you.
appreciate you.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.